So this session now, we're looking at unlisted investments. And our first speaker is Dermot Ryan from AMP Capital. Please put your hands together for Dermot.
Good morning, everyone. Thanks for your time.
Just behind there.
So I'm here today to present a solution we have for trying to generate income in the market. I'm sure you'll all agree that today's income panorama is very difficult. Term deposits, again, have been cut, and yields have been bid up to very high levels, which means that incremental yields on a lot of asset classes are very low at the moment. At AMP Capital, we've really designed a product that's tried to address some of these issues and deliver a stable monthly income, particularly to people in low tax brackets like retirees, SMSFs, and people with charity tax status. The slide here is basically showing where income has been 10 years ago versus today. The green dots you see on the top was where this time 10 years ago in 2009, income on these assets were. And so essentially you can see that back then you had a really broad suite of options to generate maybe over 6% yield in your assets. Where we stand today, it's a very tough environment. You've had bond yields rallying. There's 20 trillion of negative yielding bonds in the world at the moment. You've also seen a very sharp rally in property indexes across all the various subsectors, including residential. And really the only asset class that has similar yield characteristics than it did 10 years ago is Aussie equities. And as you can see, we've just highlighted the contribution franking gives to Aussie equities in dark blue here. Very soon you'll be getting more in franking returns than you'll be able to generate in term deposits, corporate credit, even annuities. So there's a very, very big advantage to franking. And of course, it's been very hard to take away. We also Bill's attempt back in May, and thankfully he didn't take that from you because investors need to try and basically leverage as much as possible from the tax benefits that they have, given the dearth of options. What we can see as well, if you start to use these advantages well, you can start to lift your yield, and you can get back to yields above where you were above that kind of 6% level that you were able to generate pre-GFC. And so you see the product that we're running, Australian Equity Income Generator, is yielding 6.15% for the year, and we pay that in monthly installments. And so as we look through and think about what this means from a portfolio, and from if you're a retiree, thinking about how you can generate income in retirement, this just looks at what income comparisons a retirement portfolio might look like, and it takes account of some of the intricacies around part pensions, etc. And what you can see is that now at the low yields, you're becoming worse off as you get wealthier if you invest in term deposits or fixed income, because the yields are so low. And what you can see is that across the board, even for the rich certainly, but for almost all the median retirees as well, you can see that there's a very large pickup from your franking credits, and also Aussie equities are one of the few things that can really boost your income over time. What we see in the market as well is that income provides a very large amount of returns relative to capital in the market. This chart on the top right looks at the ASX 200, which is very near price records at the moment. But if you put the ASX 200 accumulated, which basically assumes that the dividends get reinvested back into the market, you can see that there's been a very large return in Aussie equities, and that's because we're a high-yielding market, and it's been a big benefit for us globally to be able to have those high levels of yield, as well, of course, as the imputation system known as franking, which allows domestic taxpayers to avail of taxes that have already been paid by companies. So that's the positive story. I mean, obviously we've had a very good year this year. The market's up over 20% year to date and over 25 from the lows of December last year. And so one of the things I would say is that you have to be cautious as well when you're in equities, and just don't be greedy, because there is quite a good yield on offer, but you just need to be patient and think through the cycle on these things. So the chart on the bottom right here just looks at this EPS, which is basically profitability of companies in the market, hasn't really been growing because the Australian economy has been in a bit of a soft patch, but we have had a very sharp re-rate. So trying to find companies where valuations haven't run too far and they've got good cash flows and good balance sheets is pretty much the name of the game at this point in the cycle. The one thing I would say as well about kind of index level dividends is that almost half of the dividends that are being generated by the ASX 200 now are being issued by 6 companies, and that's the big 4 banks and 2 miners. So the 2 miners are very profitable. They've got net cash balance sheets, which means they don't owe anyone any money. It's almost like they've paid off the mortgage, and all the money coming in is extra. It's free cash. But of course, commodity prices have come off a little bit as Brazilian supplies come on. So we expect them to do very well for the short to medium term as commodity prices stay strong. The issue on the other side, though, is the banks. And in the last week, since we prepared these slides, 3 of the 4 banks have reduced their annual dividends. And so we've seen big cuts to where you can traditionally find yield. And so I think as you look in this space, and it is certainly at a headline very, very attractive, you've got to rethink about where exactly you're getting your income and how to target the right areas. So we think there's plenty of options to generate a good yield in the market, but some of those traditional areas, you just need to be cautious, particularly if interest rates continue to go down, because for the banks, they make a net interest margin, which is basically the margin between term deposits and mortgages are now at a level where they're very low. So the net interest margin is crimping all the time. The good news as well is that it's been a bonanza year for low-rate investors. A lot of people weren't familiar or as maybe knowledgeable on franking credits as they might have been a year ago, but what we've seen is that companies and investors are really focusing on this opportunity now. It's been the highest level of franking ever last financial year, and we've been off to a really good start. There's been 7 buybacks over the last year and 2 this financial year already. These are very accretive, particularly for those on low tax rates. And this strong franking benefit will really start to actually increase the returns you can generate from franking credits going forward. So with Equity Income Generator, we've tried to come up with a solution where to address some of the challenges of the day, like the big banks cutting their dividends. And so what we find is that we've come up with a better solution that comes up with a more diversified approach to bringing in your distributions from different parts of the market. We've been moving into the kind of mid and sometimes small cap stocks if they've got good balance sheets and cash flows and pay good franking, to try and bolster the returns you can get. You can see on the charts on the right, we've been generating a much higher franking rate than the market, and we're delivering a higher yield to the market, and we're delivering that in flat monthly distributions over the year, with all the franking credits dispersed at the end of the year. When we look across the portfolio, it's created quite an attractive characteristics. We've got less debt than the market. We've got stronger cash flows. We've got more stable dividends, so they show less volatility than peers. And we've got higher dividend growth expectations. And this is by taking a very goals-based approach to try and generate that tax-aware income and deliver it through the cycle to our investors. And that's the end of the formal slides, but I'll hand back to Peter.